Hello, everyone, and thank you for joining me today. I know it's been a minute since I've put out a video. Um, I had quite a bit of stuff kind of going on this year. I stopped making videos in March when we had a huge ice storm and we lost power in our area for about 3 weeks. It's so bad, like our forests and everything up here just looked like somebody came through with I don't know, a buzz saw and just topped all of them. And there was a lot of cleanup work. We were running on backup generators and things like that, and running around, trying to find fuel because there was no gas. The gas stations were shut down. Yeah, it was bad. There was, I don't know, several counties that were affected. So, anywho, we kind of got through that. My son joined the Marine Corps. I got kind of busy with that and everything, and ended up, leaving to go to his graduation in South Carolina. Um, so yeah, but I am back now. Okay, and we're gonna get into it. I know this may seem like a bit of doom and gloom for my first video back, right? But it's better to know and be prepared. So you've seen the headlines. The stock market's at record highs. There's a $1 trillion gold rush into AI and data centers, right? That's become kind of a huge thing. We have data centers here in Michigan, and nobody wants them. Official government numbers tell us that the economy grew 3% last year. All sounds great, right? But what if I told you there's another set of numbers, hard physical data from the literal lifeblood of the economy that tells a completely different and much darker story? Okay. Again, welcome to the show. My name is Tim, and we're going to get into it. All right. Today, we're diving into what one expert calls the great disconnect. All right. And I don't know. I don't know why my camera is doing this, but again, tech difficulties, being away for a while and trying to get everything reset up. Anywho, to understand it, we have to look at past Wall Street, or we have to look past Wall Street and Silicon Valley and look at our highways, right? You have to look at freight. Freight industry is the circulatory system of our economy, and it's how every physical thing you buy, right? This is nothing new to anybody. Whether it's a gallon of milk, new refrigerator, clothes on your back, everything, right, gets to where it is by truck. And historically, when the volume of stuff being trucked, railed, and shipped starts to fall, it's one of the clearest, earliest warnings that a broader economy is slowing down. Okay, so what is it telling us now, right? According to Craig Fuller, the founder of the supply chain data firm FreightWaves, it's screaming that a major part of our economy is already in a recession. Okay. Here's the startling data point. Freight volumes have collapsed 17% year over year. I'm sure a lot of you have already noticed this. That's a drop on par with the worst of the 2008 financial crisis, right? And Craig calls this the story of the K-shaped economy. All right. On the top of the K, the part that's shooting upward, you have the white hot sectors: artificial intelligence, hyperscale computing, data center construction, right? This is what's driving the stock market. It's incredible, transformative technology, but there's a catch, right? Craig estimates this entire booming sector employs about 2 million people. Okay. Now, look at the bottom part of the K, the line that's trending down. This is the good economy: manufacturing, automotive, energy, housing, all the freight and logistics that serve them, right? This is the part of the economy that makes and moves physical stuff. Craig estimates this sector employs 35 million people, and his data shows it is, in his words, in a significant recession. Okay. This is the disconnect. While we're all captivated by the AI boom at the top, the foundational physical economy that supports 35 million jobs is struggling mightily. And Craig argues that policymakers in Washington and the Federal Reserve are in a state of denial, okay, focusing on the strong stock market while ignoring this profound weakness where most Americans actually work. But the story gets even more concrete and more alarming when we zoom in on one specific area, trucking, right? Craig recently published a report predicting the U.S. trucking industry is headed for the largest capacity purge in its history, right? This is, if he's right, this is monumental, right? This is historical. With up to 600,000 drivers potentially leaving the market. Now, you might hear 600,000 jobs at risk and think that's a terrible sign of economic pain, and it is. But Craig explains this purge has a shocking public safety component that changes the story. For years, he says, deregulation and lax enforcement created a flood of new, often unqualified drivers into the industry. We're talking about systems where commercial licenses were issued with little to no real training, sometimes to people without legal work status who may not speak English or understand our traffic laws, right? We've all seen the news, reports on that. The result, 1 in 5 truckers on the road right now has a critical safety violation. Truck involved, fatality rates are up 40% over the past decade. Legitimate safety compliant trucking companies are being driven out of business because they can't compete with operators who cut every corner, right? So this purge is really a long overdue crackdown, right? It will remove these dangerous, illegitimate operators from our highways. Yes, it will likely cause shipping rates to rise, adding a stagflationary pressure where costs go up even as demand is weak. Okay. But Craig argues it is first and foremost a necessary public safety reckoning we are in effect, trending some economic distortion for safer roads. Okay. Finally, what does this mean looking ahead? If the goods economy is to recover, Craig believes the long-term theme is reindustrialization, bringing manufacturing and supply chains closer to home, right? This is something, if memory serves, I've said that for the last, year or two? Had many discussions with some of my colleagues about this, and that's the one thing that we keep pointing at. And so for investors, the opportunity may not be in the latest AI chip maker, but in the companies that form the backbone of that physical economy, the major railroads, the large shipping firms, and the warehouse networks. Okay. The takeaway from all this, we're living in 2 economies. One is digital, speculative, and soaring. Okay. The other is physical, essential, and on shaky ground. And the data from our supply chain suggests that until we acknowledge that second economy, we're not seeing the full picture. All right. So something to kind of pay attention to there. I know the outlook looks bleak. Part of me hopes he's a little bit wrong, right? I don't know, maybe not. I guess myself personally, I kind of need to give it a little bit more thought. I do agree with a lot of what he says, at least for the most part. That being said, for more deep dives into headlines, you know, informational training videos, make sure you subscribe. Again, my name's Tim, and thanks for watching.